Alright, what's going on, guys? Welcome back to my channel. Now in today's video, I'm going to be showing you guys how to manage covered calls in corrections like we're having right now, whatever you want to call it, correction, pullback, sell-off. Bottom line, the market's down. It's been red for almost about 2 weeks now, maybe even a little bit longer than that. So we're definitely having some rough times right now, and if you're like me and you're invested in some more higher risk, higher growth stocks, then you are probably getting absolutely destroyed. So you're not alone. Everybody that's investing in these things is getting absolutely just cratered, unless they're just the people that are jumping off and taking losses. But I'm just holding on because, you know, there's that saying that the only ones that get hurt are the ones that jump off the roller coaster on the way down, or it's something like that. But bottom line, just hang tight, just let things work themselves out. And if you absolutely need to, just cut your losses. But I'm just hanging on and I'm selling covered calls to try to make up some of these losses. So that's what I'm going to be talking about in today's video, is selling covered calls, stocks that you are down huge on, and basically selling covered calls under your share price. So we're just going to use BNGO for an example. I might use some other ones for example, but BNGO is one that I'm down huge on, as you guys can see, 42% down. So it's pretty rough, to be honest with you. So I have two covered calls right now that I sold for the 19th. I actually got quite a bit of money for them, I think. I got almost $344 from them. Yeah, $344 for those two covered calls. Now they're only worth $28. So that definitely gets this loss down a little bit. I think I've sold a couple on the same batch of shares though, so I think that number is even actually lower. So, but you know, it doesn't really matter. The point is, we're not here to sell covered calls to get our total return losses down. We're trying to make money. But when you're in situations like this, there's not much you can do other than hold on to it and work on little strategies on how to make money, like I'm going to show you guys today. So for now, we are going to go over to the TradingView chart over here. I suggest using TradingView, Thinkorswim. That's on my other brokerage. But today we're just using TradingView, and we're basically just looking for key levels. Now, as you can see, the stock's at 855, which is pretty dang low, and it does look like it's almost, it might form a support there. Not really sure. It might bounce off from right here. But you know, this whole market, this whole week has just been painful. You get these nice little runs up, you're thinking, oh, everything's great, and then it just starts cratering again. So basically what I'm showing you guys is that what I do is I need to find a support line. So I think the most eye-catching one here is around the 1050 mark around here. As you can see, it went up right there, boom, got hit, came back down, boom, broke out a little bit, but came back down, hit right here again, and then after that third try, it just absolutely sold off. So it's definitely struggling to get over that 1050 mark right there. Plus, we had some news on BNGO the other day. Well, not really news, just an article that somebody wrote that said he's basically rotating out of BNGO and waiting for it to come back down to a more reasonable level. I think he said around 750 was where he was going to try to buy it. So, I mean, it's really not that far off, sadly, but it'd have to drop quite a bit still to get down there, actually. So that's a negative catalyst, obviously, that, and plus just the whole, you know, market selling off, basically. But anyways, back to the strategy. So you want to find a resistance level. So right here, like I said, it's around 1050. So what I do from there is I find that resistance level, and then I go up and try to find the next resistance level, which this one isn't as clear, but it kind of does look like it's kind of in the $11 to $11.50 mark, which that's a huge range, don't get me wrong. But it just has to be a decent estimate, because once it breaks this resistance, then it's going to have to, you know, break higher and try to make the next resistance. So if it stays in this $8 to $10 range throughout the month until the 19th, which is where my two covered calls expire for this month, then I would most likely sell an April 16th one for around $12. Now, that is significantly under my buy price. It's a little bit risky, I know. If you don't want to take that much risk and not risk it getting hit, then you want to go to 13 maybe, or just do whatever you're comfortable with. But this is just my strategy. I find one resistance, go up, find the next, and just, you know, sell a covered call a little bit above that. So let's go back over to BNGO. So let's look at the trade BNGO options. Now, this isn't going to be very easy to show just because we don't know what the premiums are going to be in the next 2 weeks here. But anyways, so if we go to April 16th over here and we sell the 12 one, we get 92 bucks. It's probably going to be a little bit less or a little bit more depending where the stock price is by then. But yeah, I would most likely sell the 12 or the 13. Now the reason I'm doing this is because we're going to use time decay to our advantage. Now time decay works for your advantage when you're actually selling the calls. If you're holding a call option, then time decay really sucks and it eats away really quick at your money. But when you're selling the option, it kind of works in your favor. But anyways, back to the strategy. So yeah, I would most likely sell the 12 or 13. These premiums, you will not know what exactly they are, but you're gonna let's just say, for example, it's 92 bucks. We take our 92 bucks, and if the stock starts crashing again, it's gonna suck, but at least we got a little bit more profit. We brought our cost basis down a little bit more. Now if it skyrockets and gets really close to your strike price, then you are going to have to get a little bit creative. Now, like I said, time decay is on your side. It's kind of impossible to see what these are actually going to be valued at the time. But as the option gets closer and closer to expiration, the time decay just starts growing and growing, and it just starts, falling really quick. So you want to pick a price that you think is not going to get hit by the next expiration. You're going to want to sell a covered call on that. If it gets too close, then you're going to have to buy it back or risk the chance of losing your shares. And in my case, I would lose close to, $500 to $600. So I do not want to do that, but I think it will take a little bit for this stock to keep rising. So I would do the 12, wait it out. If it gets too close to my strike price, then I would have to buy it back. And in some cases, if it reaches the strike too quick, then you might actually have to pay more than what the premium is that you got. So that's why there's a little bit of strategy involved with this. You have to pick a price that you don't think it's going to hit within the time span of your option. But if it gets close and your option only has like a couple of days before expiration, then this price is going to be dirt cheap. You're probably only going to have to pay, instead of, you're probably just going to have to pay $12 or $15 to get your call option back. So you're still making money. You're still making about 80 bucks, but you just basically limited your downside more by selling it and getting the premium. Now I wanted to show you guys a stock with weekly call options just to basically show you guys the time decay. So right here we have the 123 strike price at 119 each share, so you get $119. Now if we go to March 12th, we go to 123, it's $249. So that is almost double your money. That's actually a little bit more than double your money right there. So just the difference in 1 week shows you how much time decay an option has. So 123, this is almost $250 for one covered call. You go to March 5th, it's $120 pretty much, $119, whatever. So the bottom line here is that you're basically using time decay in your advantage because you're either just going to sit on the stock, wait for it to return, or take a little bit of risk, sell a premium, and risk it getting close to that number and having to rebuy the option, which I think is a much better option, especially if you're down huge on the stock. If you're only down, 10% or something, you could probably just wait it out. But I mean, in the instance of me with BNGO, it's down to 40. I'm down almost 43%. So I do have to do something. So just to outline basically what the strategy is. So number one, you go on the chart, you find the resistance level for the stock. Then you want to go up and try to find another resistance level. So then we got 1150 around 11-ish. Then you want to just go up a little bit from that and 12. I mean, you could try to predict it without looking at the chart. It's a little bit hard though, because you do want to see where the resistance is basically and where it needs to break out from. But for my analysis, I would sell one at 12. It's a little risky, but it's something I'd be comfortable doing. So then you sell the option, you get the premium, and then you basically have to watch it though. If it gets too close to that strike price, then you're going to have to buy it back. Now, depending how long that option has until expiration, it could be more or it could be less to buy the option back. I don't think it's going to be a huge significant amount though, but it's definitely worth it to protect your upside. So like I said, let's say I sell one at 12, it gets close to 12, I have to buy the option back. give up some of my premium, but it just protects me if this stock just continues selling off, or if it stays in a range of $8 to $10, then it lowers my cost basis, and it just gives me more of a chance to make money on this stock. Now I know it's a little bit confusing, so let me just show you one more time on, let's say, Virgin Galactic here. So I'd say the next support level for this one is around $30 right down here. So I mean, if it drops any lower, it's going to be pretty painful. I have a covered, actually I think my covered call actually expired on this one, but anyways, support level is probably 30. The next resistance that it's going to have to pass is 39, around 40, before breaking any higher than that. Now from there to 48, that's a huge jump though, so you might want to pick something in the range of 48 to 40, or whatever you feel comfortable with. This one definitely is a really quick stock though. I think the main reason we saw all this up here though is because of a little short squeeze basically. But just keep an eye on the charts, be safe where you put your covered calls, and if you have to buy them back, it's not that big of a deal. You might take a little bit of a loss on the premium, but most likely due to time decay, you'll be buying the option for cheaper than the premium that you initially received. But that's my strategy, guys. I know it's not like a one fix all for covered calls when you're in a correction like this, but that's what I'm going to be doing during this time period, just to get my cost basis down and generate a little bit of income. But if you guys have any questions, leave them down below. But I hope you guys enjoyed this video. If you did, make sure to leave a thumbs up, subscribe if you're not already, and I'll see you guys in my next video. Peace out, guys.